Have you ever spent weeks, maybe even months, watching a currency pair? Just waiting for that absolute perfect technical setup.
Oh, yeah.
You know the exact one I'm talking about. The price is coiling up, the consolidation is getting tighter and tighter, and you are absolutely convinced, like bet the farm convinced, that a massive breakout is imminent.
Right. It's the trader's dream scenario, really. Everything just aligns perfectly.
Exactly. So you position yourself, you size up your trade, you're ready for the fireworks, and then nothing. Silence.
Or it's even worse.
Right, or even worse, it pokes its head out, triggers your entry, and then immediately snaps right back into that boring, choppy range.
Yeah.
It's like the market is just completely asleep at the wheel.
It is the classic false breakout. And I mean, it is incredibly frustrating. Honestly, it's probably the #1 reason retail traders just completely burn out and quit.
Frustrating is putting it mildly. It
Mm.
feels personal. You start asking yourself, is this chaos? Is the market just random noise? Or is there some dark room full of guys in suits manipulating the price just to hunt my specific stop loss?
Which is a very human reaction. I mean,
Right.
we want to find a villain. We want to believe there's a they out there messing with us. But usually, well, almost always, it's not manipulation. And it is certainly not chaos.
So what is it then? Why do these markets just sleep for months, trading in these tight ranges, and then suddenly explode into volatility without any warning?
It comes down to one fundamental truth that we are going to explore today. Currency markets are not casinos. They are highly structured systems. And the most important thing to understand is that these systems only change. Prices only truly trend when incentives change.
Incentives. Okay.
Yeah.
That sounds deceptively simple, but I have a feeling we are about to go way deeper than just, people want to make money.
We have to. If you want to stop getting chopped up in the noise, you need to move past the price action. You have to stop just looking at the lines on the chart and look at the actual cause of that price action. We're going into the engine room of the global economy today.
I love it. We are ignoring the shiny paint job and looking straight at the mechanics. So, to you listening right now, have you ever looked at a chart and wondered why a perfect technical setup failed? Or why a currency kept rising even when the news looked absolutely terrible?
If you have, this deep dive is entirely for you. Because once you understand the incentive structure under the hood, all those mysteries start to make a lot of sense.
Now here's where it gets interesting. To understand incentives, we have to first redefine what the FX market actually is. Because I think a lot of people treat it exactly like the stock market, just with different ticker symbols.
That is the first fatal mistake right there. FX is fundamentally different from equities. When you buy a stock, let's say Apple or Amazon, you are buying a piece of a company.
Right.
You are making a bet on absolute value. You're betting that the company will grow, they'll sell more phones, and the company itself will become worth more dollars.
Yeah, if I buy Apple, I want Apple to go up. I don't really care what Microsoft is doing at that exact second.
Yeah. Precisely. In equities, everybody can win at the exact same time. If the economy booms, all stocks can go up together. But the foreign exchange market is a relative valuation system.
A relative valuation system.
Right. There is no absolute value for the euro. There is only the value of the euro relative to the US dollar, or relative to the Japanese yen, or the British pound.
So it's a zero-sum game.
In terms of valuation, yes. Every single exchange rate is a contest. It's a literal tug-of-war between two currencies. If USD goes up, the euro is winning and the dollar is actively losing.
It's like a sports match.
Yeah.
One side winning naturally implies the other side is losing. You can't have both teams win the Super Bowl.
Exactly. And that exchange rate, the score of the match, if you will, expresses exactly how attractive one currency is compared to the other right now. But here's the catch, and this is where traders get really tripped up. Attractive means vastly different things to different people.
This is a crucial point. When I'm sitting at my computer, I'm thinking about profit. I want to buy low and sell high. I just assume everyone else in the market is doing the exact same thing. But that's not true, is it?
Not at all. That assumption is why so many retail strategies fail miserably. The ecosystem of participants is vast, and the guys in fleece vests looking at charts, the speculators, are just one tiny slice of the pie. In fact, we are the minnows. You have to look at who is actually moving the heavy money.
Let's break down that roster. If the market is a tug of war, who is actually pulling the rope?
You have to start with the central banks. These are the whales: the Federal Reserve, the European Central Bank, the Bank of Japan. But here is the critical distinction you have to make. They are the only participants in the entire market who are not profit motivated.
Right. Jay Powell isn't looking at his year-end bonus based on his trading P&L. He's not staring at a 15-minute chart of the dollar index, hoping for a moving average crossover.
Exactly. Their incentive is purely mandate-driven. They care about macroeconomic stability, inflation, and employment. If the Federal Reserve needs to crush inflation, they will hike rates and strengthen the dollar, even if it causes a recession, and even if it bankrupts a dozen hedge funds.
Wow.
They are the referees, but they are referees who can just pick up the ball and walk out of the stadium if they want to.
That's a terrifying thought, honestly. They have infinite ammo.
Literally infinite. They can print the currency. So when you are trading, you always have to ask yourself, am I fighting the guy who owns the printing press? If the answer is yes, you lose. Plain and simple.
Okay, so that's the apex predator. Who's next in the ecosystem?
The commercial banks. These are the guys engaging in the everyday plumbing of the financial system. They are facilitating liquidity, they manage balance sheet exposure, they need to ensure that when you tap your card in Paris to buy a croissant, the transaction actually clears behind the scenes.
So they aren't placing directional bets either.
Generally, no. They are driven by flow and liquidity needs, not necessarily a directional bet on whether the euro is going up or down next week.
So they are the mechanics keeping the machine oiled.
Okay.
But then we have the corporations, and this is a huge chunk of volume that I think retail traders just completely ignore.
Absolutely massive volume. Think about a massive multinational company like Toyota or Volkswagen.
Okay, giant car companies with global supply chains.
Right. Toyota sells millions of cars in the United States every year. They receive billions of US dollars in revenue from those sales, but their factories, their workers, and their headquarters are over in Japan. They have to pay their staff in yen. So every single month, like clockwork, they have to sell dollars and buy yen.
And they don't care what the chart looks like.
They couldn't care less if the RSI is overbought or if there's a massive double top pattern forming. They have a massive payroll to meet on Friday. They must execute that trade. Their incentive is purely operational. They are price insensitive.
This is a huge light bulb moment. You could have a perfect technical setup for the dollar to go up against the yen, but if it's the end of the month and Toyota needs to repatriate $1 billion back to Japan, the price is going down.
Precisely. And that forced flow creates what we call noise or chop in the short term. But it also creates massive structural trends in the long term. If Japan is suddenly exporting less cars, there's less organic demand for yen, period. No amount of technical analysis changes that corporate flow.
That is such a key distinction. They are trading to remove volatility from their balance sheets, whereas a speculator is trading to capture volatility for profit.
Exactly. Then you have asset managers and sovereigns, your pension funds, sovereign wealth funds. They are allocating capital globally. If a massive Norwegian pension fund decides it wants to buy U.S. tech stocks, they have to sell their krone and buy dollars first.
So the currency move is just a byproduct.
Yes. That flow is driven by the asset purchase, not a view on the currency itself. They are rebalancing massive portfolios, not gambling on FX rates.
And finally, us, the speculators.
The ones trying to anticipate all these value changes. But here is the thing that ties it all together. Despite these wildly different goals, stability, hedging, asset allocation, speculation, every single one of these participants responds to the exact same shared framework of incentives.
They're all eating from the same menu.
They are. And that menu has 5 main items: yield, risk, liquidity, policy credibility, and capital mobility.
Okay, let's unpack this menu, because this is the hidden engine we're talking about. If we understand these 5 pillars, we understand why the entire market moves. Let's start with the big one, the one that arguably drives 80% of the long-term trends: yield.
Yield is usually the driver of the bus. Think of it as financial gravity. In its absolute simplest form, money is sentient. It wants to go where it is treated best.
Show me the money.
Exactly. If I offer you 2 savings accounts, Bank A pays you 0% interest and Bank B pays you 5% interest, both are equally safe. Where do you put your cash?
I put in Bank B. I'd be an absolute idiot not to.
That is the entire FX market in a nutshell. This is the foundation of the carry trade, which we'll discuss in detail later because the math there is just fascinating. But the core incentive is clear, that maximize the return on capital. If the gap between those interest rates widens, the incentive to move money across borders becomes stronger.
Next on the list is risk. Because getting 5% is great, but not if the currency devalues by 20% overnight.
Right. Risk refers to volatility and tail risk, the chance of a total disaster. Institutional investors are terrified of losing their principal capital. So even if a currency offers a sky-high yield, like, say, The Turkish lira often does. If the political situation is highly unstable or the underlying economy is crashing, the incentive to hold it just disappears. The risk completely outweighs the reward.
It's the old picking up pennies in front of a steamroller problem.
Exactly. Then we have liquidity. This is the can I get out when the building catches fire incentive.
The fire exit.
Precisely. Major institutions move billions of dollars at a time. They cannot trade in thin, illiquid markets. They need deep liquidity. If a currency is illiquid, meaning it's hard to buy or sell large amounts without moving the price wildly against yourself, the incentive to hold it drops significantly, regardless of the yield.
Because they need to know the door is wide enough to fit through if they suddenly need to run.
Exactly. Okay, number 4 is policy credibility. This feels a bit more abstract, but I have a feeling it's crucial.
It is abstract but vital. Do you trust the central bank? If a central banker stands up and says, "We are going to do whatever it takes to fight inflation," do you actually believe them? If the market trusts the policymaker, they will hold the currency.
It's like trusting the pilot of an airplane. If he gets on the intercom and sounds panicked or confused, you're suddenly looking around for a parachute.
Exactly. If credibility is lost, if the market thinks the central bank is incompetent or politically captured by the government, capital flees incredibly fast. We saw this in the UK a few years ago with the mini budget, which we'll touch on later.
And the last pillar, capital mobility.
Are there rules preventing me from moving my money? Capital controls. If I put $1 billion into a country, can I actually take it back out? Think of the Hotel California. You can check out anytime you like, but you can never leave.
If a market is Hotel California, nobody is checking in to begin with.
Correct. If a government imposes strict regulations or locks the exits, the incentive to enter that market evaporates instantly, no matter how good the yield is.
So we have these 5 pillars: yield, risk, liquidity, credibility, and mobility. The thesis here is that when these 5 things are stable, the market must consolidate.
That is the stability principle. Think about it logically. If the interest rate gap isn't changing, the risk profile is steady, liquidity's fine, and the rules of the game haven't changed, why would you move your money?
You wouldn't. You just sit there. Toyota does its usual monthly flow. The pension funds do their usual quarterly rebalancing.
And that is exactly why markets range. Price fluctuates a little bit based on daily speculative noise, but the underlying structure doesn't change. The market is in perfect equilibrium. Those false breakouts happen because retail traders try to force a trend when the institutional incentives are still screaming to stay put.
This is a huge aha moment. We always think a range-bound market is waiting for something, like it's building up energy. But really, it's just the natural resting state of stable incentives.
Yes, markets only trend, they only actually reprice when the relative reward-risk calculation shifts. One of those 5 pillars has to crack or expand.
But the real story is how this completely shatters the way most of us look at charts. I mean, we spend hours drawing lines, support, resistance, triangles, flags. But if what you're saying is true, those lines don't actually do anything.
This is the illusion of technical analysis. Now, don't get me wrong here. I'm not saying charts are completely useless. I look at charts every single day. But technical patterns describe behavior. They do not cause behavior.
That's a distinction a lot of people miss. We talk about a support level holding price up like it's a physical floor made of concrete.
It's a metaphor that gets us into a lot of trouble. A support level at 1.05 on the euro doesn't hold because the line on your screen is magic. It holds because, at that specific price point, under the current incentive structure, no participant has a compelling fundamental reason to force the price any lower.
So the sellers look at the price, look at the yield and risk, and say, it's just not worth selling anymore down here.
Exactly. And the buyers look at it and say, well, at this price, the yield looks attractive enough to step in and buy. The incentives balance out right there. That creates the support level. It's an equilibrium of incentives, not a geometric barrier.
And this perfectly explains why breakouts fail. You see the price cross that magical line, you get super excited, you hit the buy button, and it instantly reverses.
It reverses because the breakout didn't come with an actual incentive shift. We call this the breakout fallacy. A breakout only works if the underlying incentives support capital follow-through.
What do you mean by follow-through?
I mean, new, heavy institutional money entering the market. If price breaks a technical high, but interest rates haven't changed and the economic outlook is exactly the same, why would big asset managers suddenly pile in? They won't. It's just smaller speculators pushing the price around. So the move runs out of oxygen and falls right back into the range.
I love this phrase from our notes. Price is the messenger. Incentives are the message.
That is the core philosophy of macro trading. If you are just reading the price action, you are essentially reading the mail without ever opening the envelope. You see the envelope moving around, but you have absolutely no idea what's inside.
So let's open the envelope. We know the 5 pillars now, but we need to understand the mechanics of the shift. How do these incentives actually change in the real world?
It usually starts with monetary policy, but we have to look way beyond just the headline interest rate. It's about risk models and capital controls.
Give me an example of a real structural shift.
Take China tightening their capital controls. That is a massive policy shift. It directly impacts the capital mobility incentive. Suddenly, the offshore liquidity of the yuan changes. The forward premiums adjust. It completely changes the math for every single corporate treasurer doing business in China. That is a structural shift, not a speculative one.
So it's not just, oh, rates went up. It's the actual rules of the game change.
Exactly. But of course, interest rate differentials are the heavy lifters. This is what drives the carry trade.
Okay, we touched on this earlier, but I really want to drill down into the math here, because carry trade is a term people throw around on financial TV all the time, but I don't think everyone understands just how powerful and how dangerous it actually is.
It is the drug of the financial world. Imagine for a second you can borrow money in Japan at 0% interest, essentially free money.
Okay, I go to a Japanese bank and I take out a massive loan in yen.
Then you take that yen, convert it immediately to US dollars, and you buy a US Treasury bond that's paying 5%. You are now pocketing that 5% difference for doing practically nothing.
Sounds exactly like free money.
It feels like it too. But here is where the pros make it dangerous. They don't just do it with their own cash, they use leverage.
Walk me through the leverage math on that.
If you are a massive hedge fund, you might leverage that trade 10 to 1. So you borrow 10 times your actual equity capital. Now, that 5% yield spread, it becomes a 50% return on your equity.
50% risk-free. That's insane.
It's insane until the exchange rate moves against you. Because this whole beautiful structure entirely relies on the yen staying weak or flat. If the yen suddenly strengthens by 10%.
My loan, the actual money I have to pay back to the Japanese bank, just got 10% bigger.
Right. And since you are leveraged 10 to 1, a 10% move against you wipes out 100% of your equity. You are completely bankrupt.
Wow, okay. So that explains the extreme violence of the moves when these trades unwind.
Exactly. When the incentive to hold the carry trade shifts, even just a tiny bit, everyone rushes for the exit at the exact same time to pay back those yen loans. That massive buying pressure sends the yen even higher, which triggers margin calls for other traders who then panic and buy more yen to cover. It's a vicious, unstoppable feedback loop.
So the carry trade only really works when expectations are perfectly stable.
Yes. This trade only changes the market trend when the expectation of future rates changes. If the gap stays at 5% forever, the market stabilizes. But if traders start to think, oh, the US is going to cut to 4% or Japan's going to raise rates to 1%, suddenly the math changes and everyone stampedes to the door.
That naturally brings us to speculative incentives. This is all about the future.
Speculators live entirely in the future. They don't care what the price is today. They care what the price will be 6 months from now. This is why a simple unemployment number can massively move the market.
Right. I've always wondered about that. Why does a jobs report move a currency so much? It's literally just data about the past month. It's history.
Because that historical data changes the expectation of future policy. If unemployment suddenly spikes, speculators immediately think the central bank will have to cut interest rates soon to save the economy. That lowers the expected future yield. The incentive to hold the currency drops today, so they sell right now.
So news releases equals new data, which equals new incentives.
Precisely. And then you have the hedging incentives. This is the real economy driver we mentioned earlier with Toyota.
The massive corporations.
Yes. Corporations hedge to manage their business risk.
Yeah.
But they don't change their hedging behavior because a chart looks bullish. They change it because their actual underlying business changes.
Like if global supply chains suddenly shift.
Exactly. If China's exports slow down globally, think about the huge ripple effect. Less demand for Chinese goods means fewer US dollars being converted into yuan by global buyers. That fundamentally alters the daily flow. Or if a major auto company decides to build a massive factory in Mexico instead of China, that's a structural multi-year shift in the capital flows. These are very slow-moving but incredibly powerful trends.
So we have the core theory down, but I really want to see this in action. because when you start looking at market history through this specific lens, it's like putting on X-ray glasses.
It really is. Let's look at the 2022 US dollar supercycle.
Oh man, 2022, the dollar was an absolute wrecking ball that year. It crushed everything in its path. The euro collapsed below parity, the yen hit 150. It was just brutal if you were caught short the dollar.
And do you remember the narratives on the news back then? People were constantly saying King Dollar or it's a safe haven play because the world is scary with the war in Ukraine.
Yeah, there was a lot of talk about U.S. exceptionalism. People were calling it the cleanest shirt in the dirty laundry basket.
But the incentive reality was much colder, much more mathematical than that. It was a massive yield incentive shock.
Break that down for us.
The Federal Reserve suddenly realized they were way behind the curve on inflation. CPI hit 9%, they panicked. So they started hiking interest rates faster than they had in decades. They went practically vertical, doing 75 basis point hikes meeting after meeting.
And what were the other central banks doing?
The European Central Bank lagged way behind. They were terrified about energy prices and a winter recession. The Bank of Japan, they literally stayed at zero. They refused to budge an inch.
So you had this massive expanding cavern opening up between the interest rates of the U.S. and basically everyone else in the developed world.
Exactly. Holding U.S. dollars suddenly paid significantly more than holding anything else. Cash literally became a high-yielding asset. If you could get 4 or 5% risk-free on cash in dollars, why on earth would you hold a European bond paying 1%?
You wouldn't. It's mathematically superior to just hold the dollar.
And that's the ultimate lesson. The dollar didn't rise because traders suddenly liked the U.S. economy more or because the daily chart printed a bullish engulfing candle. It rose because the incentive structure, specifically the massive yield differential, made holding dollars the only rational choice for asset managers and reserve banks globally.
So all those carry trades reversed. Foreign reserve managers had to buy dollars to defend their own currencies. It was a massive global stampede caused by a single powerful incentive shift.
Correct. And as long as that yield gap persisted and kept widening, the trend persisted. No amount of overbought signals on an RSI indicator could possibly stop it.
Now let's look at the exact flip side. What happens when incentives don't change at all? Let's talk about the euro from 2015 to 2021.
Ah, the boring years.
Yeah, agonizing years, honestly. USD was just stuck between 1.05 and 1.25 for what felt like an absolute eternity.
And retail traders screen manipulation every single week on Twitter.
Oh, yeah. Why want to break out? Look at this massive weekly bull flag.
But it was pure incentive stasis. Think about the macroeconomic relationship between the Fed and the ECB during that entire multi-year period. Their policies were highly predictable. GDP growth in the U.S. and Europe was relatively similar. There was no existential crisis forcing anyone's hand.
No big institutional player had a reason to move money aggressively across the Atlantic.
Exactly. Speculators would push the price up to the top of the range at 1.25, realize there was absolutely no fundamental reason for it to go any higher, and they'd sell. Then they'd push it down to the bottom at 1.05, realize yields weren't different enough to justify a total crash, and they'd buy it back. It was a perfect self-sustaining equilibrium.
Let's zoom out for a second, because sometimes incentives don't just shift slowly like the dollar in 2022 or stay flat like the euro. Sometimes they violently snap. We have to talk about the Swiss franc in 2015.
The Frankageddon.
I remember looking at the live charts that day. It literally looked like a data glitch. The price just teleported down the screen. It was one of the craziest things I've ever seen in financial markets.
It was one of the most violent moves in modern FX history. To understand it, we really have to look at the dangerous nature of policy floors.
Set the scene for us. What was actually happening in Switzerland before the crash?
So the Swiss National Bank, the SNB, had an official policy. They declared that 1 euro is worth 1.20 Swiss francs. They drew a massive line in the sand. They told the global market, we will not let the francs get any stronger than this level.
And they actively backed it up.
Well, they backed it up. They printed unlimited amounts of francs to buy euros in the open market just to maintain that artificial price floor.
So the entire market believed there was an unbreakable safety net.
They believed it was ironclad. This created a very weird, very distorted incentive structure. There was essentially a negative incentive to hold the franc because the central bank was actively fighting its appreciation every single day.
So everyone just confidently sold francs.
Everyone sold them. Until January 15th, 2015, it was just a regular Thursday morning.
Right, 9:30 a.m., everything is completely normal.
Then at 10 a.m., the SNB suddenly published a press release announcing, we are stopping the floor. Immediately.
They just pulled the rug.
They incinerated the rug. The incentive flipped instantly. Before 10 a.m., holding francs was a mathematically bad idea. At 10:01 a.m., holding francs became a risk-free appreciation trade because every big player knew the currency was massively artificially
The
undervalued.
dam just completely broke.
The incentives flipped from sell francs to buy francs at absolutely any price in a microsecond. But here is the truly scary part. Market liquidity just disappeared.
Because nobody in their right mind wanted to sell.
Exactly. If every single participant in the world wants to buy, and literally nobody wants to sell, price doesn't move smoothly down a chart. It gaps. The price crashed 30%, which in major currencies is like the Dow Jones going to zero in a matter of minutes.
I heard horror stories of retail traders ending up with massive negative balances in their broker accounts.
Oh, absolutely. Major brokerages went totally bankrupt that afternoon. People lost their entire life savings and the time it took to go to the kitchen and grab a coffee.
That is the terrifying power of a policy incentive collapse. When the fundamental rules change that drastically and that suddenly the repricing is discontinuous, it doesn't gracefully trend, it violently gaps.
Exactly. Incentives flipped instantly, so price reprice instantly to find a new equilibrium.
Let's look at another one that confused a lot of people recently, the Japanese yen and the British pound. Two very different stories, but both driven by these exact same hidden engines.
Let's start with USDGPY from 2021 to 2024. This was arguably the most one-sided macro trade of the decade,
The yen just kept getting weaker and weaker. It was relentless.
and the Japanese government desperately tried to stop it. They intervened directly in the market. They spent tens of billions of dollars buying yen to prop up the exchange rate
But it just didn't work. Why?
because they were filing a massive structural incentive with volume, not with actual policy. The incentive was painfully simple. The U.S. Fed was rapidly tightening, meaning rates were going way up, and the Bank of Japan was still doing yield curve control.
Yeah.
They were literally printing money to keep their own interest rates pinned at zero.
So the mathematical incentive was still screaming, borrow yen for free, buy dollars for high yield.
Exactly. The Ministry of Finance buying yen for one afternoon doesn't change the underlying fact that borrowing yen is still free and holding U.S. dollars pays you 5% risk-free. As soon as the government stopped their buying intervention, the market looked at the yield incentive, shrugged its shoulders, and went right back to aggressively selling yen.
You really can't fight the math. It's like trying to stop a raging waterfall with a plastic bucket.
You cannot fight the incentive structure. Currency intervention only works if it serves as a credible signal for a coming change in actual monetary policy. If the underlying policy stays exactly the same, the intervention failed every single time.
And what about the British pound post-Brexit? Specifically, that crazy moment with the mini budget a few years back under Liz Truss. That was a wild ride.
That wasn't just panic selling like the media portrayed. That was a brutal, real-time repricing of capital allocation incentives.
How so? Walk us through the mechanics of that.
The UK suddenly became a significantly riskier place to park capital. The new government announced massive unfunded tax cuts during an inflation crisis. The bond market completely revolted. The risk and policy credibility pillars we talked about earlier, they absolutely collapsed overnight.
So global investors looked at the UK and basically said, I just don't trust you to manage your economy anymore.
Exactly. To keep their capital in the UK, the global market demanded a significantly cheaper pound to compensate for that massive new risk.
It's like demanding a steep discount on a damaged good. I'll buy it, but only if it's 30% off.
That is exactly it. In finance, we call it a risk premium. The currency rapidly devalued until it reached a price level where the reward, which was buying now cheap UK assets, balanced out the terrifying new risk profile.
This is truly fascinating because it moves us away from the emotional narrative of, oh, the pound is crashing, to a very clinical view of the pound is simply finding its new mathematical equilibrium based on increased risk.
It's a much healthier, much more professional way to view the market. It totally removes the emotion and the politics.
Right.
It wasn't a speculative attack on the UK. It was a cold mathematical adjustment to a new risk environment.
So we've thoroughly covered the theory, the underlying mechanics, the horror stories, and the history. Now we need to give the listener the actual toolkit. We need to install a new mindset.
We need a complete paradigm shift. Most traders spend their entire lives staring at screens asking, where will price go next?
Right, is it going to 1.10 or 1.05? Just tell me the target number.
Which is the completely wrong question. The right question, the only question that matters is, which incentive has changed?
Diagnosis over prediction.
Yes. You need a mental checklist. When you see a big market move or you're expecting a move, you have to ask yourself four things. Did yield differentials change today? Did central bank policy credibility change? Did capital mobility or regulations change? Did global risk pricing change?
And if the answer to all of those is no,
If the answer is no, expect the market to chop sideways. Expect that beautiful technical breakout to fail miserably. Expect mean reversion. Do not chase the move.
and if the answer is yes,
Then and only then can you confidently expect a sustained trend. If the Fed chairman comes out and shocks the market by saying, we are raising rates to 6%, the answer is yes. A major pillar just shifted. Now you can buy that breakout and hold on for the ride.
this sounds so incredibly disciplined. It really takes the casino gambling aspect completely out of the equation.
It forces you to look at the why. Price only tells you that something changed. Incentives tell you why it changed.
I really love that phrasing. Price is just the symptom. Incentives are the actual disease or the cure.
And this brings us to a really deep macro insight. When we look at these global currency markets, we are seeing a massive, living, adaptive system. It's not a static picture. It's millions of participants constantly calculating cost versus benefit in real time.
So for the listener who wants to actually use this framework tomorrow morning when they open their trading terminal, what exactly do they do?
First step, completely stop staring at chart patterns in isolation. A perfect head and shoulders pattern means absolutely nothing if the central bank hasn't fundamentally changed its mind about interest rates.
Step 1. Contest is king. Do not trade in a vacuum.
Step 2. Start aggressively reading central bank communications. Look at forward interest rate expectations. Look at what the sovereign bond market is doing. The bond market is usually the smartest, most ruthless guy in the room because it deals purely in mathematical yield.
So if bond yields are moving, currencies are eventually going to follow. The bond market is the dog, and the currency is just the tail wagging.
Precisely. And step 3, train yourself to look for structural shifts, not just temporary price blips. A 50-pip move on a random Tuesday afternoon might just be corporate hedging noise from someone like Toyota. A change in a major central bank's inflation target. That is a tectonic shift.
It's all about filtering the actual signal from the daily noise.
Exactly. You want to be hunting for the big game, the major incentive shifts. You want to be positioned on the side of the underlying incentives, not fighting against them.
This has been an absolutely incredible deep dive. It really reframes the whole game for me. Instead of exhaustingly fighting the waves every day, you're telling us to look at the moon that actually causes the tides.
That's a beautiful analogy, and it leads to a final, slightly provocative thought I really want to leave everyone listening with today.
What's that?
We very often think we are just trading a currency pair. We think we're just trading the euro against the US dollar to make a few quick bucks. But we are actually trading a global worldview.
A worldview. Okay, that sounds a bit philosophical for a finance deep dive.
It is, but think about it. Every single incentive structure we talked about is a direct reflection of how the world is functioning at that exact historical moment. Is it a world of peaceful global cooperation and free trade? A world of rampant inflation? A world of war and fractured supply chains? When the core incentives change, it means the world itself has fundamentally changed.
That is profound. The chart is quite literally just a real-time map of the world's current state of affairs.
And if you are still stubbornly trading the old world, if you're stuck on the old incentives, you will get absolutely run over by the new one. The global market is completely ruthless about adapting to new realities. You have to be too.
Wow. When incentives change, the world has changed. That is definitely something heavy to chew on.
It keeps you humble.
Yeah.
And more importantly, it keeps you intensely curious. You have to always be asking yourself every morning, has the world changed today?
Absolutely. Well, there you have it. The hidden engine driving the global markets isn't some secret dark pool algorithm. It's just the basic human and institutional drive for yield, safety, and stability. Once you see these incentives working under the surface, you truly can unsee them.
And your trading will honestly never be the same again.
Thank you so much for breaking all of this down with us. And to you listening, go out there and actively hunt for that next big incentive shift. We'll see you on the next deep dive.
See you next time.